Hey guys, what's up? This is Andrew for TRENDLINES.com. So for those who are watching my video for the first time, very quickly, let me introduce myself. I used to work as a professional trader for 6 years and I just resigned 1 week ago. And actually last Friday, yesterday was my last day. So next week, guys, I'm going to be able to be here with you every day to do updates for your preferred stocks like AMC or GameStop. And then the week after, guys, I'm going on holidays to see my family. So it's going to be a bit tougher, but I'm still going to give you some updates. So today I want to make a huge update, guys, on AMC. Let's get into it. Alright guys, so as usual, let's start on the 4-hour time frame and let me remind you what I was telling you in my last video. So we were here developing in a triangle that was labeled as my fourth wave of this 5 waves development that started at 8, guys, on the 10th of May all the way up. I told you guys the levels where we're gonna have some reactions. I told you roughly how long would be the consolidation. I was just using, what I like to use, which is Elliott wave theory, trend lines, divergences, all these kind of indicators that for me help me to actually choose my preferred scenario. So in my last video, I was spotting here a triangle, guys. So A, B, C, D, E. I showed you guys in the Elliott wave, book that I always keep here with me. What is a triangle? Sorry. Alright guys, so these are all the types of triangles that you can have. It can be ascending, descending, converging, or expanding. Alright. And here we have a converging triangle that is making 5 waves here. And I told you that if we break out here, so let's zoom in, guys, let's go on the hourly time frame. If we break out here, it means that this triangle is over, that the 4th wave is complete, and that we are starting the 5th wave. I also told you guys, and I was quite accurate here, that we are going to correct to 52, guys. All right. So 52, I found it using different methods. So I encourage you guys to go and watch the video I published just before this one, because it's actually very interesting to see, when some methods work, the reasons why they worked, and so that we keep using this. And here I was using Fibonacci retracements, I was using trend lines, and I was using this breakout. So I found that we are going to bounce back around the 51, 52 levels, guys. So basically we went here to 51.87 first, and the second time we retested it at 51.69. So very close actually to my levels. And then as expected, we bounced back. For now, everything looks perfect. And we bounced back, and for me, we are starting the 3rd wave. So now I'm going to break down this video in 2 steps. The first step, we are going to analyze the facts, what we are having, and then we are going to use this and try to combine it with what we know and build different scenarios and select the preferred one. So as usual, guys, I'm going to give you my view in this video. So the first thing we're having, so I've been telling you guys this for actually more than 1 month, that this 50 period moving average on the hourly time frame is actually the one that is giving us the best reactions. All right, so you can go and check in the past. It was giving us very nice reactions all the way up. Then here, when it got broken, we had this strong move down. And then here we broke it on the upside again. So, it's working for a very long time. That's what is good about spotting something that is working. You can keep using it, all right? And it's never going to be the same thing that you're going to use on different stocks, or even on the same stock, but at different time. When something is working, it's usually working for some time, and then suddenly it's not working anymore, and you need to switch to what is working again. So here, this is working, guys. I'm giving you this when it's not going to work anymore. We're going to see it. And I'm going to tell you that it's not what we need to look at anymore. For now, this is what is working the best. And look here. So we break it on the upside. Then let me even zoom in a bit more, guys, because right now I have more time, so I'm making, you know, shorter term analysis with you. I'm gonna make another update on Monday's close, guys, and on Tuesday's close again. I have now more time, even if my contract is not finished. You know, I'm right now in this period where, you know, that we call the garden leave. So basically I'm still under, like, my contract is not finished yet, but I don't need to go to work, so I have more time. So I need to stay on the hourly time frame. All right, and you can see, so we break it, we retest it, guys. So I told you, go check my other video as well. This was one of the reasons I told you 51, 52, guys, is because I had this moving average here and it acted perfectly as support as we expected. And so we have 1, 2, 3, 4 candles, 5 candles, then we have the rebound. And here, guys, I mean, you know, this was an easy trade. You know, if you do some scalping, of course, you know, AMC is not the best stock to do scalping, but it's just an example. You can lock easily some small profits, but with a very high probability of being right. And then here, look, I have an example of a fake out. So it's very interesting to look at because, you know, even when something is working very well, the market is still going to make some tricks. So here, this breakout, you know, is not perfect, but you can see that on the hourly time frame, we close below one time, just a little bit, but, you know, theoretically it's enough. Then a second candle below again, and then we have this strong rebound. So here it is what we call a fake out. So fake outs are actually very tricky, and if you use this moving average as a stop loss, here you would have stopped your position. All right, that's true. Now let me show you guys, and I'm going to talk about it in the course that I'm building right now, guys. It's going to be in few chapters. There is one chapter on breakouts, and I'm explaining you guys exactly how to play breakouts and how to avoid fake outs. And one of thing you absolutely need to look at is the volume. And if your breakout occurs with small volumes compared to the volumes you're having, you know, in the same period, then this is likely to be a fake out. And here, look, the volumes we have. So it was 17th of June, 11, the timestamp. All right. Look at my screen, like on the downside. So I'm going to find the associated volume, guys. It's this one. All right. So basically, there is no volume even here. Okay. Let's say this is not the breakout. The breakout is here. You can see at 12. What is the volume here at 12? Guys, it's zero volume. So basically this fake out is a fake out because it occurred with zero volume. So if you are trading this, you can't consider this as a breakout. So just here, I'm giving you some tips on how to avoid the tricks the market is making to us every day. So then we go higher and we come back here and we close the week with a bit of weakness. That's true. But guys, look at the market. The S&P 500 was down, I think 1.5%. Nasdaq down as well. All the European market got destroyed. So actually AMC hold very well compared to the other stocks. So here, I think that even if we had some weakness, this is still looking good. We are still trading above this 50 period moving average on the hourly time frame. That is for me very important. So this is one fact. Then second fact that I need to show you guys. I told you that here we would go down. You remember why, guys? Because I told you we have a divergence, all right? Market going higher. So we had this divergence on the 30 minutes time frame. All right, so let me show you this again. Here, market making new highs, and the MACD making lower highs. All right, you remember? And this was on the 30 minutes time frame. So I told you that on the 30 minutes time frame we have a divergence, but we don't have it on the hourly. So we're gonna have a small move down and then rebound. This is what happened. Now, if I go back on the hourly time frame, I have here something, guys, that I want to show you. Is that we have an exaggerated bearish divergence, all right? So this is one more fact that I need to show you. So basically market making flat, basically. So going to the same level, it traded on the 15th of June around 64, 65. And during this time, the MACD is actually making lower highs. And this is true on the hourly time frame, and it's also true on the 4-hour time frame. You can see that here the MACD is making maybe you don't see. The MACD is making lower highs on the 4 hours and on the hourly. So once again, let me show you this, guys. This is this one. Okay. So market making a flat move. with the momentum indicator decreasing. So basically we're losing steam and the market is not able to actually make a new high. So you can see that here usually we should make a new high with more momentum. This is what happens during moves up, but we fail, you know, we go higher, but with, I mean, not higher at the same level, but with less energy. So it's almost the same as the regular divergence. It's a bit less powerful because here the market is making new highs. So this is really, you know, diverging, market making higher highs, MACD making low highs. Here is being flat and the MACD decreasing, but it's still a bearish divergence. All right. Even if it's less powerful. So we need to take into account, and now we're having it on the hourly time frame. So it's going to affect the price action a bit longer than the one we had on the 30 minutes time frame. So this is a second fact. Now, the third fact I want to talk about, and I showed you guys this in my previous video as well, is that this first wave here is perfectly broken down into 5 waves and is respecting very well the Elliott wave theory, which is saying that when the third wave is extended, then the first wave is usually equal to the 5th wave. So let me show you guys this as well. I know I'm repeating a bit things, but it's very good for you guys to see this many times. It was this example. So I told you that when the third wave is extended, so here we have different scenarios with different ratios. This is Elliott wave book, guys. You can find it on Google. Just type, you know, Elliott wave principle, thrust and pressure PDF, and it's the third link. It's this one. So here it's saying that when the third wave is extended, 1, 2, 3, 4, 5, you have 5 waves inside the third wave, then wave 1 is equal to wave 5 in terms of lengths, all right? And you can have a look at this. I'm not going to go through this here with you guys because this is not what we're having. And you can, you know, use these ratios as well if you see these scenarios happening. So here, my facts are, I repeat, we have the triangle, we broke out on the upside, doing 5 waves. We broke the 50 period moving average on the hourly time frame. That was the resistance. We are perfectly supported by it and we close above it during the week. We have a fake out with very low volume, so we could avoid it very easily if we know how to trade breakouts. We have this, our first ABC corrective pattern. And then here we are doing the third wave. So in the third wave, we are just breaking down, you know, those 2 first moves into 1, 2. So right now, my preferred scenario, guys, is that on Monday, we're having a very strong move up and we are starting the third wave. We should start the third wave. This is what should happen. But once again, we're having this sneaky, exaggerated divergence that might cause some trouble. So I have an alternative scenario. So once again, this is my preferred scenario, but I have an alternative scenario where actually here we're making an ABC here. It's basically a combination of corrective patterns, you know, that is consolidating, usually doing a sideways correction. And here we might have another, you know, kind of ABC. So this is an alternative scenario and this is possible as well. And then this would be the 1, 2, and then of course 3, 4, 5. So this is possible as well. And to know how deep we could go, we can use again retracements. And you can see that here we have plenty of room, guys, because during this impulsive moves, the second wave usually retraces to 50 or 61.8%. So we went to the 50% level that I told you guys, 52. But we might also go to the 61.8% retracement level, which is around 48. And we have on the hourly time frame, the 200 period moving average coming here. So this would be an alternative scenario that could still be valid, that would still not invalidate my longer term analysis that is saying that we go to 135 in this 5th wave. I'm just wondering if the second wave is complete or not. And once again, this exaggerated divergence for me is not strong enough signal, indication to tell me that my preferred scenario is changing. So my preferred scenario, I remind you guys, is still the same one. So we're making here a 1, we finish the 2, and this is a 1, 2 in the third wave. So I don't think this would happen. I think we're going to have a bullish Monday. So let's see. So that's it for me. I hope you enjoyed this video. And if you did, please don't forget to click on the sub, like, and bell button. So you're going to be the first to know when I upload anything new. And stay close to shore. I'll see you guys.